Fantastic. Thanks a lot, Anth, and thank you all for joining us. So this talk is going to be on financial reporting for agency owners, but a lot of the concepts are going to be really relevant to pretty much any service business, and some of them are just timeless concepts that can be used across all business. So I think there's value in here for a wide variety of people, even though this is aimed at agency owners. And it's about how knowing your numbers will help you make better strategic decisions. And we're going to walk through a few different situations and questions that will help frame how knowing your numbers will help you with these decisions. So I just wanted to start off with a poll, a couple of poll questions. So if you slide down, you're looking at these slides, if you slide down, you should be able to see a little tab that says polls. And you'll see the biggest challenge when it comes to understanding your financial reports. There should be two questions there. The first one is, what's the biggest challenge when it comes to understanding your financial reports? And the second one was, what was your total revenue for the past 12 months? And that'll help us put you into a different category, and then that will frame how you kind of look at this presentation as we go, because some of the topics are suggested for bigger agencies and some are suggested for smaller. Great. So we've got a good mix of revenue. And so in terms of the challenges, we're getting reports, but not 100% sure how to read them is 33%. And making strategic decisions using the reports is the biggest challenge when it comes to understanding them. That's fantastic. That's great. I think there'll be some real value in both of those. So I'm heartened to see that nobody selected not getting reports. That's great to see. And everyone's fairly confident of their data because no one's selected that one. So that's great. At least you're in a position where you can leverage this information. And we've got a pretty even split of revenue levels across the board. So that'll be good. And I'm going to include some information for all different revenue levels. So I think that'll still cover you. Great. Thank you for answering those. All right. Let's help you understand your numbers and make some better strategic decisions. Quick introduction, who am I? I am passionate about helping small businesses make an impact in their communities. I've been part of B Ninja's team for over 3 years in counting. And before that, I started in audit and had a few different roles in the finance team of big film productions as well. But now I've settled into the small business world and I love it. And I love the freedom and I love helping people that are really connected to my community, which is really motivating for me. I'm a virtual CFO, I'm a coach, profit first consultant, and I'm also a chartered accountant. So I've got a little bit of knowledge in these kind of worlds, and that's why I'm giving the talk. So let's consider 3 different scenarios. And I think there should be a good range within the audience here this morning or this evening, depending on where you are. The first one is Andy. Andy doesn't have any financial system in place. He might be too busy running the business to worry about that kind of stuff. He may have started as a freelancer, won a few jobs, and now he's built up and has a couple of staff occasionally helping on projects. And Andy's biggest problem is, how the hell am I really performing? This is common. We see a lot of clients come to us in this stage where they're good at doing what they do, but maybe not so much running the business and the numbers behind it. So that's the first persona that you may relate to. Second one is Kate. This is kind of one level up into the growth phase. She is using Xero or potentially QuickBooks if she's US based. She can read a report. She might have brought a couple of staff on and having to start managing them and managing payroll, and potentially looking at dealing with some cash flow issues as she's growing. So kind of that one step above. Kate's main problem is, can I even afford that? And trying to manage keep all the plates spinning in her business. The third and final persona is John. So John has got his Xero set up well. There's been time put in. It's been reviewed by an accountant. He's happy with that aspect of it. He might have his finance operating procedures in place, so that's all kind of documented. And he's built a good team. And John's burning question for this morning is what is his business worth? He's spent years and years building this up, and he's not sure really the asset that he's put in to build. Um, so those are the three different kind of personas potentially. My question to you: who do you resemble the most right now? Andy, who is just getting started as a freelancer and kind of dipping his toe into being a business owner. Kate, who's in that growth phase, growing, got multiple demands on a time, but still kind of got the structures there. Or John, who's got that established process in place and is looking at what's next or what his assets worth. So if you could share, if you're an Andy, Kate, or John, that'd be great. And these are not clear cut. Obviously, there's various mixtures of stages, and some people have a booming business but maybe no processes. That's great. So we've got a good mix. We've got a couple of one Kate, a couple of Johns, a couple of Andys. That's cool. It's fantastic. So we seem to have a good range in the audience, and I think that'll be great because I've broken this up into 3 different sections to try and cover off some of those key questions. So today's agenda, we're going to talk through some launch pains, so getting visibility over your performance, and also what metrics matter. We're going to look at some growth pains, which is that mid-tier stuff. We're going to look at paying yourself the right wage and also investing for growth and working out if you can afford to invest in growth. We're also going to finish it off with some kind of quick tips about maybe what your business is worth and what an investor or the bank will care about when looking at your business. If you're looking to build to sell, or at least get a loan from the bank and prove your worth that way. And then, as a bonus, I'm going to talk you through how our upcoming Know Your Numbers course can help you get a better understanding of your reports in order to make some strategic decisions. So I'll give you a little bit of explanation about what the course is all about and how it works in terms of the structure of it and what you get. Let's dive into it. Cool. Launch. How the hell am I really performing? I love this quote. A person who aims at nothing hits it with amazing accuracy. So it's important to have targets. I think that's very important in all aspects of life. First, in order to have a target, we need to have our house in order. In order to set a target or even know where you're at, to set a baseline, you need to have accurate data. And this is the foundation of any successful business. It's just having good, clean data. That involves an accounting system. We use Xero at BNinjas, but there's QuickBooks, there's multiple cloud-based ones that we recommend. So it's having a good accounting system in place. It's using business bank accounts, not your personal ones. It's having a consistent coding routine. So putting them all to the same expense and revenue codes. So when you run your profit and loss, it makes sense to you and you know what's happening in your business. You might be developing a bookkeeping timetable. So that might involve having an accounts payable process, an accounts receivable process to chase up debts and make sure you get paid on time. It's having all of those foundational cogs of what a successful business is across any industry. It's just having those things in place. And then the last part of having your house in order is obviously getting regular reports. And I guess the whole point of our course, which I'm going to speak about at the end, is once you've got those reports, using them and using that information to help you improve the business moving forward. So I think in order to set targets or to work out how the hell you're going, you need to have this in place to begin. This is a handy little diagram we've done to show you the flow of this. So you're going to have, obviously, in order to get your relevant reporting, you're going to have the right accounting system in place, which connects into your business bank accounts. You're going to be coding regularly, and that's going to be on a regular basis, and you're going to be getting great reports. And that circular thing will continue in that rhythm, usually done on a fortnightly or weekly basis, depending on your business, in order to give you this good, clean data to make these consistent decisions, with the whole aim of spotting problems early or being able to see opportunities early and pounce upon them. instead of doing your books once every 2 months, once every 3 months, or when your tax is due, are not really understanding what the hell's gone on that year. So you're looking backwards rather than forwards. A quick recap on the key financial reports. I'm sure some of you will be familiar with these, but I won't go too in depth. There's the balance sheet. So it's what your company's worth, and it's worth comparing over a few different periods to see what has been happening. It's obviously where all your assets and all your liabilities are, and hopefully you're in a net asset position. You can see this balance sheet here. Their net assets is in a negative position, so not a great spot to be. But this is a key report that we go through on the course and try and monitor to make better decisions. Obviously, profit and loss. This is the first one most entrepreneurs will look at, which shows all your revenues and expenses. And that's obviously one that really should be analyzed on a regular basis. And we'll go through kind of a bit of profitability stuff later in this chat. And then the third one I wanted to introduce was a cash flow forecast, which I think is really essential to any business. And this brings in that forward facing piece about trying to plan for the future ahead. So those are the three kind of key reports that I think any business owner should have in their arsenal in order to help them make strategic decisions. So in order to work out how you're performing, so like looking at something like this or something like this, to the untrained eye, can be really confusing. There's lots of numbers, there's lots of columns. What the hell does it all really mean? The whole point of trying to whittle things down into a metric is to make it easier for you to keep your finger on the pulse of how your business is performing. And I think this tip down the bottom here in white is really, really important. The focus with metrics or like key performance indicators, KPIs, that it's actually mainly on the movement of these metrics over time rather than the actual number you've got. I mean, the number you've got is still a baseline and important, but each business is different. They have a different kind of business structure or cost base. So you want to look at the movements over time to tell you the story of what's been happening and the trends of what's been happening. It's the same, for example, when you're analyzing a cash flow forecast. If you see your revenues going up or down, why are you forecasting things up or down? The same with profit and loss. We never analyze a profit and loss with just one column of what's happened last month. We're looking at what's happened over the past 6 months. We're going back in time and trying to read those trends. That's where the real value is in these kind of reports. So I've listed here 8 ones worth thinking about. This is mainly aimed at agencies, but I think most service businesses could really get a lot of value from thinking about tracking these. You want to whittle it down to maybe like 5 or 6 key ones that are really relevant to your business. For example, if you don't have any staff right now, labor efficiency may not be as important for you to be tracking, but I think like timeless ones that you really should be tracking across most businesses: sales conversion percentage. How efficiently are you converting your leads into customers? That's across all businesses. Top line revenue should obviously, most entrepreneurs naturally look at this, but that should definitely be. Profit is another one that we'll talk about later, but that is obviously a key focus of all businesses. Things like project profitability are really worth considering if you are kind of project to project basis, and that's making sure that each project is profitable in its own hub. And then you can also see if certain staff members working on projects are less productive than others, and you start to see little intricate details like that. Break even point, that's obviously not your goal, but I've often found that having that as a metric, I've called it the keep the lights on target. But that's when you as the owner can breathe a sigh of relief knowing, you know what, we've hit that, we can make payroll, everything's good, everything on top of here is cream. And that's sometimes a nice mental thing to have, knowing that you've hit it. And sometimes the goal with break even point is just hitting it earlier in the month. And then obviously you've got more days in the month to make that cream or that profit. Accounts receivable aging, you want to make sure that your people are paying you on time. And that's obviously really important to get that in. There's no point doing the work and then not being paid for it. and cash runway, which is a bit of a cash flow forecast term, but that's making sure that you've got enough cash or capital reserves to keep you going for a while in the event of unforeseen things or revenue dropping through the floor. So those are some metrics or some key performance indicators that I think are really might be worth setting up. The way we do that with our clients is that we usually set them up in a dashboard, and that way it's all deposited in one local spot, and they can read it all easily. So instead of having to look at the mess of a profit and loss, it's kind of presented with just 5 or 6 key metrics, and you look how the metric has been trending over time, and that helps tell the story, and it helps simplify this wash of data into something a little bit more manageable. So that's worth doing, definitely. Meet Stevie. Stevie's on our course. She was completely overwhelmed by not knowing what was going on money-wise with her business, and she went from having no idea about how Xero worked or how to read a profit and loss statement to feeling like she was comfortable with all of those things. And she owns a agency called Stevie Says Social. So that's a nice testimonial from Stevie. All right, quick question. This is about how often you're reading and analyzing your financial reports. So if you could just throw it in the chat here. No judgment. You can be honest. It doesn't matter. Are you getting them? That's fantastic. We've got a weekly. Fantastic. Monthly. Yeah, monthly is really common. Well, that's great. It sounds like everyone's reviewing them fairly often. Kelly's looking at them weekly, fortnightly, but not analyzing them. I suspect that with I've suspected that with some of our bookkeeping clients before, that we send the reports, but there might not be reading them or truly trying to understand that. I think that's the next level. That's kind of why we created this kind of group mentor courses, is to try and provide that spark to get people interested in getting the useful data out of it, rather than doing these reports for a compliance reason. Like most people are motivated to do these things because they have to show something to the tax office more often than not. So this is about trying to put you in the pilot as the owner to fly the plane a bit better and make better decisions. But that's great. It sounds like everyone who's on here is still getting them regularly and looking at them regularly. So that's fantastic to hear. Okay, we're going to move into the second of the 3 topics, growth. And if you remember that persona, I think it was Kate. Her burning question was, can I even afford that? So 2 topics within that I'm going to talk about is firstly paying yourself. And then the second one is investing in growth and knowing when you can start investing in growth, or when does your business have the cash flow to do that? So in terms of paying yourself, some really, really common problems that we see. The owner might be taking too much out from the business as an owner drawings rather than a wage, and that doesn't show up on your profit and loss, and that distorts your profit and loss results. The owner might not be paying a consistent wage, and it's done based on gut about how the business cash flow is going. And quite often, the most common is actually the owner underpaying themselves, and the business actually looks more profitable than it is because they're not paying themselves a market-based wage. So, and I'll discuss that one in a little bit more depth on the next slide. So just a recap on how owners can take funds from the business. You can take a wage or salary, via payroll, and that's obviously shown on your profit and loss. You can take directors' fees. You can take dividends, which are obviously a distribution of the profits. Depending on your company structure, you can also take a distribution. And the other one that I mentioned up the top, the owner drawings, which is a bit of a hidden killer for some businesses because, as I said, it's hidden away on your balance sheet and it's not being reflected in your profit and loss. So those are some ways that owners take funds out of their business. So we recommend some key considerations when working out what you should be paying yourself is how much do you need? So a livable, sustainable wage for your lifestyle, your mortgage levels, all of that kind of stuff. But also, probably more importantly, is what is your market rate for the role you're performing in your business? So you should be getting an idea by looking at job ads for similar roles. You could speak to recruiters, or recruiters quite often will send out, their own lead magnets, which are these PDF reports of state of the union of what salaries are worth. You can also look at competitors to gauge what your market rate will be. So if I'm assuming you're all owner of your business, you should be looking at, are you performing as a CEO or are you head of sales? Quite often owners will wear many hats. So what percentage of your time are you spending as CEO versus head of sales versus other roles? And try and piece that together to work out what your market rate should be. And that's probably what you should be aiming for. You can't always pay yourself that to begin with, but that should be probably your first priority to try and get the business up to a sustainable level where you're paying yourself a market-based wage. Why does this matter? Why am I speaking about it so much? Because most people understate their true wage expense. The business appears more profitable than it really is. And this hides other issues in your business model for too long. You make poor decisions based on the incorrect metrics and you scale up an unprofitable business. You might think that you're doing well at this smaller level because you're underpaying yourself, and that's hiding a structural problem in your business. Maybe you're pricing your goods too cheap. Maybe you're not delivering them efficiently enough. But you're going to get to a stage eventually where you can't build yourself out of the business as you can't afford to hire anyone. The true market-based wage that you'll need to pay someone else to replace you can't afford because the business hasn't been built with the right structure. So you're kind of kicking the can down the road, so to speak. And so you want to get clear on what the right model is in order for all of this to work. And the aim is to be paying a market-based wage and have a good return on your investment, on your business as well. So it's about having a balance of those two things. And that's kind of why it's really important to have that on your mind. Okay, quick question. What is the dream annual take-home pay? You can use the chat. This is, just imagine you're comfortable, happy, no money stress. This isn't like, you don't need to be Dan Bilzerian or Jeff Bezos. We're not talking about that. We're just talking about a good, comfortable life to be happy. 200 is a great goal, definitely. $200K after tax. Fantastic. That seems to be the magic number. Karen said that Bezos's net value increased by 13 billion overnight. Holy moly. Mark saying his sole trader is objected to have zero profit at the end of the year, so I'm not trying to grow profit in the company. Goal is to get to 400K per year. Okay. Thank you for sharing that. It looks like 200K is a similar goal for a few people. So this is assuming that you're the sole owner of the company. And here's a rough guide based on some profit first percentages. So if your goal is to be taking home 200K per year, the required business revenue, your first goal is at 500K. And that's probably at the lower end of what your business needs to be earning in order to be paying yourself 200K. So these are obviously rough figures. This is not black and white. And depending on your business model and your cost base, it will change. But this shows the relationship between what your pay is and what the business needs to be earning in order for you to sustainably pay this. Now, you might be wondering where I'm getting these figures from. So if we take that 200K, you need to be earning at least $500,000 in order to take that home. It's based on a system called Profit First. We go through this system in the course that I'm going to mention at the end. It's essentially a way to break up your business into these manageable chunks, and you split up kind of the key areas of your business. It's called Profit First because you're supposed to be taking out your profit first into a different bank account and ensuring that you're profitable to begin with. It splits up your business into 5 key accounts or foundational accounts. It's got your income account, your profit, you also start to put aside money for your owner's pay and also to make your tax payments. And then what's left over is left for your operating expenses, and that's what you've got to run your business. So it's a fairly, there's a little bit more to do with it, and this isn't, I don't want to touch on profit first too much, but it's basically a way to split out all the key areas of your business and make sure that all of them are being met at the right levels. So you're not forgetting to pay your taxes and you're not underpaying yourself, but also you're still paying your operating expenses. And so the percentages, or that the goal setting thing for dream take home income, was based on this percentage. This is based on hundreds and hundreds and hundreds of implementations from Profit First, both Profit First USA and Australia. And this is a guide of what a fiscally healthy business is paying the key areas in their business based on their revenue range. So for an example, for a real revenue range of 500K to a mil, the owners usually taking about 20% of that revenue home as their revenue. I should stress this is only a rough benchmark guide. This is not, it very much depends on the business structure, but it's just a way to help you break up what you should be setting aside to meet your tax obligations, what a good level of expenses is, and whether you're maybe paying too many expenses in your business. It helps give you that a rough idea of the balance between these key areas. The second part of growth, can I afford that? So the two questions I have when asking this, are you profitable enough currently? And what percentage are you spending on expenses in relation to other areas like your taxes and owner's pay? So to answer the second one first, just going back to this slide, if your operating expenses are a huge percentage of your business already, and you want to commit to making another big ad spend, we might have a conversation like, well, what else are you currently spending your money on? And is there anything else in expenses we can look at to reduce before we commit to this additional ad spend? So these are the two questions. Let's go through them. I just want to chat through quickly profitability. I think most of you on this call sound like you're probably on top of this, but if we pretend like this is an SEO job, so they're doing search engine optimization for a client, 10K is a 10K job, and to pay the staff to do this, it's 7K wage. So you're running a gross profit of 3K, or about 30%. On top of that, you've got to pay your rent, your normal kind of software subscriptions, all that kind of thing. That takes out $2,000. So from the gross profit of 3, less the overheads, we've got a net profit of $1,000, or 10%. So a 10% net profit margin is a great goal to begin with. And what that means is for every $10 you earn, the business is keeping $1 in its bank account at the end of it. If you push that margin up to 20%, for every $10 you earn, the business keeps 2%. So margin is a really powerful thing, and obviously the higher margin, the more cash you're keeping in bank at the end of the year. At or below 5% is break even for net profit. So that should be your baseline goal. I think 10% is a really healthy level to have in the business, and 15% plus is a fantastic business, is a great business. At 10%, you can start to leave this cash in your business and reinvest it in growth. When you're running at a net profit percentage of 5, I don't think the business is generating enough cash reserves. You're not having enough cash left in the bank after you've met all of your commitments to enable it to invest in future growth. So I think at 10%, you can start to look at, okay, we've got additional cash reserves sitting here. What are we going to do with them? So some practical tips to work out, can I afford this? And so when I say, can I afford this? I mean, can I afford a staff hire? Can I afford that extra marketing budget? It can be multiple things that you think are worth investing to grow your business. Some practical tips. Run a forecast, a 12-month cash flow forecast scenario with this additional hire or with this additional advertising spend. We call this scenario analysis. So you'll have your cash flow forecast for your baseline of what is the most realistic, depending, like the most realistic situation. But then what we'll do is we'll copy that and we'll say, you know what? Okay, in this scenario, let's say we've hired another staff member and run that additional advertising spend. You plan that out month on month, the additional cash commitments that you're thinking of making, and you see how your business looks. Can it sustain it? Will the revenue cover it? Are you going to start running out of cash in a few months' time? That helps map it out month on month to see if you can really afford it. Another simple way to do it, maybe if you're not running a cash flow forecast, set up a separate bank account. Allocate this weekly or monthly commitment across for a whole quarter and see if you need to steal from that bank account in order to fund something else in your business. Quite often, if a business is only running one bank account and they're not doing a forecast, they know they've got cash in the bank, but it's all convoluted and they're not 100% sure what is coming up. And to be honest, the most common thing that I see that people forget is your tax debts. There's so many successful businesses that I've seen, they still have a huge tax bill from last year's income tax or, sales tax, GST. That seems to be a blind spot for a lot of owners, which is why Profit First is fantastic because you are setting aside funds for that regularly. So if you think that you need to spend it on that additional staff member or that ad spend, think about putting it in a different bank account and sitting it there. And if your business is sustainable for 3 months in a row without having to steal from it, it could be a sign that you can afford it. That's a very crude way of doing it, I should say. And running a forecast is obviously a much more refined process. And analyze, be slow to hire and quick to adjust if needed. So avoid long-term commitments where possible just to test it. That's why a lot of staff are put on probation for the first 3 months. So the business can make adjustments if it doesn't work out. Some other practical tips, benchmarking, and that's kind of what Profit First helps you with, which is those percentages to guide your expense allocations. So you have a look at what your expenses are currently making up, what they have previously. You might have a look at similar businesses of that revenue range and say, you know what, I think we still have we're pretty low in our expenses. We could probably afford to spend a bit more for growth. And I think putting yourself in a strong capital position before you make these big moves is a really worthwhile thing to do. So building up some capital reserves before making a big longer term commitment. So you've got 3 to 6 months worth of expenses set aside in a vault before you start to make these riskier decisions in just in case things go wrong and it doesn't work out. So 3 to 6 months is a guide of like a cash that you should have on hand. Or another way to look at it is maybe 10% of your annual revenue built up in a separate vault to help you through these periods. And that'll help you have a stronger balance sheet and get you through the tougher times. So hopefully that gives you some ideas about if you want to invest in growth, the ways to test if you can afford it, but also putting yourself in a stronger position before you start doing that. So this is the end of the second section. I just wanted to recap how some of these concepts link together. And so you are the person walking on the train tracks here. And it's about balance. Like anything in life, it's always about balance. You're using the cash flow forecast up ahead to try and predict the future. And you're monitoring your key performance indicators to help keep your finger on the pulse of where your business is going. And that cash flow forecast is helping you predict what the future will hold for you. In this middle section where it's balance, that's your dashboard with the KPIs. And that's what you're checking weekly to make sure that things are ticking along well and nothing's out of balance. And then behind you is your past performance. That's your profit and loss. That's your balance sheet. These are still extremely important things to be looking at. But as you know, it's only a record of what historically has been happening in your business. So you need to use all of these in concert in order to help guide you in your strategic decisions. So not only your dashboard, which has got your KPIs, they're going to feed into your forecast, which you're updating monthly to help plan for the future. And you're also using your past performance to feed into your forecast to see what trends have been happening. And then hopefully that should keep you on the tracks, keep you balanced, and keep you moving forward. This is a testimonial from Dennis, who did a cash flow forecast with me. The whole process and the whole picture are made clear. I now understand when we can go with a new product to the market. And that was great. We helped mapped out a products launch for Dennis, and when he was going to hire staff, when he was going to start the ad spend, and fit that in with how his business was currently performing. So that was that's a great example of something that really helped him plan for the future. Pop quiz. You can just give me a rough idea here. What is your current net profit for the past month, maybe the past quarter? Or for the Australian people on the call, if you just got your accounts back for 30 June 2020, maybe the net profit percentage for the year. Or if you don't know, you can just put don't know in the, just throw it in the chat. Not sure. Usually around 15%. That's a good level. So that's a really handy, easy metric. That's probably the first metric you should be looking at, which is just taking your profit. You can get that straight from your profit and loss. And I know in Xero, you can actually just amend your report to include the percentage, not just the figure. And that might be a really handy way to at least get your first metric on the board of maybe the key metrics you want to be tracking. Fantastic. Well, that finishes the first two sections, and we're going to quickly touch on the established questions. What is my business worth? First, we're going to talk about what drives value in your business, and then maybe some common ways that people look to value a business. What drives value in a business? This is called a driver tree. It's quite often we run these when doing a cash flow forecast to work out what the key inputs or the key data inputs are to be monitoring that will influence our future performance. So it's a really simple way of whittling down what your net profit will be with all of these different inputs. So you can see for this example, it flows through from your website users or your traffic, how many of those you're converting into customers. Then the customers, what's their average order size with you? How big are the projects that they're ordering with you? And what's that normal gross margin? That's going to flow through into revenue. And then obviously the cost it takes you to deliver that revenue combined with the revenue is your gross profit, which then flows into net profit, which is going to be help feed into the value of your business. Profit is like oxygen for your business. You can't go too many periods with no profit, or you're going to run out of oxygen pretty quick and your business will fail. You'll start running through cash reserves, or you have to start relying on debt. So having a healthy net profit helps feed and grow the value of your business. So this is one way to kind of think about maybe breaking up in your business. What are the key things that's driving it? And this will help you select what your key performance indicators are that you should be setting up or you should be monitoring. So, I think I mentioned in one of the KPIs earlier, like sales conversion percentage is obviously a big one for a lot of people. And then depending on your business, you might want to select a couple of other things. So maybe try and set up a driver tree for your own business and see what are the big key drivers. So net profit is only one part of the equation of building a valuable business. Here are some more elements of value. So customers, are they long-term? Are you not reliant on one or two big clients? Do you have a good spread of customers? Do you have long-term contracts with them that you can rely on? You're going to look at your employees, and obviously the number one employee is yourself. Do you have a quality team? Do you have a good culture as well? We're going to look at processes. Do you have documented standard operating procedures? And that's kind of what I spoke about at the start by having your house in order. Do you have a good accounts payable process, accounts receivable process? Are they documented? And part of having those processes in place is that you're not reliant on the owner. So if someone wants to buy your business, if they pull you out, the whole thing will collapse. So it's having something that will run without you. What's your capital position or your cash position? And you'll hear this quite often when they talk about the stock market, that they have a strong balance sheet. So do you have a strong balance sheet? Do you have a lot of cash on hand? Or have you got those capital reserves I spoke about? Another element of value is your brand or intellectual property. Can you prove its strength? Do you have something that no one else in the market does? Your secret sauce, your Kentucky Fried Chicken secret recipe that they like to spruik? Um, is that adding value to your business? And then when thinking about the value, you also got to consider macro factors such as the current economic environment. If we're heading for a deep and prolonged recession, obviously prices are going to be limited. Industry specific factors, if it's an emerging sector, which, you know, digital agencies are definitely growing, but also the barriers to entry. Can someone start one up tomorrow with not a lot of skills and experience and compete with you? And we'll also dig into the micro factors that you should be considering. So the nature of the specific services that you're offering, and are they going to be changing regularly? Um, is the owner ingrained into it, and can they not build themselves out of the business? And also the potential growth of these businesses. Um, I know we do a little bit with Empire Flippers, who are like a business broker, online business broker. And for them, sometimes a lot of the online businesses, their multiples when getting valued are a little bit hampered because of the constantly changing nature of the online business market. So in ecom, certain ways of Amazon delivery were booming for a while, but then now have tailed off. So it's a really volatile market in some things, whereas something like an agency where you can prove that you're offering your clients long-term value and you've got consistent results, your revenue multiple will be higher. These are ways to assess the value of your company. I'm not going to get too in depth with this morning. It's a very complex thing to value a business, but this is just to give you an idea to think about when building your business and trying to build the value in your business. Some things to think about. A common way to do it is multiples of revenue, or EBITDA. So that's kind of basically trying to whittle down what your operating profit is for the business. And then the way that, depending on the market factors and how stable your business is, you'll be given a revenue multiple. So, for example, your business might be 4 to 6 times your EBITDA as a valuation. This is only a rule of thumb. You can also look at the assets. So, obviously, assets minus liabilities is owner's equity, or the leftover value in the business. If you have a huge amount of debt in liabilities, you're not going to have a big asset because your liabilities might be bigger than your asset. So, that's not going to be included in the valuation. And so, they might value your business purely based on the cash flows, not so much on the assets. So people choose their valuation carefully depending on what the strength is in their business. You also, obviously, like a house, market based, you have a related sales for a similar sized company. And quite often, what happens in the end is a combined approach. So people might take 3 years worth of your pre tax profits plus any other assets you have on hand. So this is a few different ways to think about valuing your company. And the reason I've included this in the talk is just when you're trying to build your company, it'll help you make decisions around what things do I want to build that are going to be a long-term valuable thing for me. Do I have my processes documented in place? Maybe that's one. Have I built a quality team? Have I got my capital or cash on hand? And do I have quality customers that are going to be with me long term? So those are things that I think are really good to guide you when growing your business and making strategic decisions. And those are just some ways that, the bank or an investor might be looking at valuing your company. This is Henrique, or Henry. He did the course with us in the most recent run earlier this year. The thing that changed from before the course and after was the way I was looking at our profitability. Their main focus was on growth. And after the course, it became very clear, quite a sense of urgency, that profitability is something that we should look into more. And I'm working with Henry at the moment about their pricing structure and their model to try and become more profitable and not just chase that top line revenue growth. Okay, question time. What drives the value in your business? Do you have a top customer who is helps you drive most of it? Do you have a great team? Are you the number one value provider in your business? So this could be, I'm opening this up to a wide range of things. If you put on your investor or hat as a bank looking to give you a loan, what do you think is the most valuable thing? Is it your contact list, your network? Has anyone got any ideas about what drives the value in their business? For Karen, it's dollars, so probably cash flow, I think. That's one I didn't mention in the value is doing a discounted cash flow on the business. That is another common way to assess what the positive cash flow is a business is generating, and that's included in the value. Kelly's got a broad range of customers, 50% Oz, 50% international. That's a great mix. That's great, Kelly. We at Bean Ninjas, we're a international company as well, and that's part of our strategy is we help online businesses and agencies, and our online clients are all over the world, which helps. It's kind of a natural hedge, I guess. Trying to figure it out. So one thing targeted at a small geographic market. But if you're really good at that, then that's still fantastic. Oh, waterproof sheets for potty training kids. Oh, that's really interesting. Very interesting. Thanks for sharing. Fantastic. All right. Just a quick recap. The 3 areas of focus. We talked through some launch pains, getting visibility over your performance and what metrics really matter. We talked through some growth pains, which is paying yourself properly and then working out if you can invest in growth and if your business is profitable enough right now to be investing in those things. Otherwise, you need to get that house in order and get your business running at the right level before you start making those bigger expense commitments. And then I talked through some established pains. What are you worth? What an investor or a bank cares about? What's your biggest takeaway from this training so far? Hopefully you've gotten some value. We covered a fair few things there. If you want to share in the chat, was it some getting visibility over your performance? Was working out some key metrics that you're going to look at? The importance of paying yourself? Maybe you wanted to invest in growth and you got something out of that section this morning. If you want to throw in the biggest takeaway. Importance of paying yourself, that's great. Great. Profit first. Yeah, profit first is really handy. We run through that on the course with everyone, and I'm a certified profit first professional. So part of what I do in Bean Ninjas is helping people implement it properly, it's really good. It's really popular, but it's popular for a reason. It makes a lot of sense. Cool. Now I just want to talk you through how the course can help. Common challenges with knowing your numbers. What metrics should I be tracking? Not being accountable, inconsistent with your books or reports. Creating everything from scratch, not having any templates to do it, not having a cash flow forecast template to do it, which we give you in the course. Not being a numbers person and avoiding it. I see this all the time. And maybe you don't typically talk with other owners about your numbers. Part of the strength of this course is that you actually get a forum moderated by me that actually helps you discuss challenges with other business owners that maybe you haven't had that kind of forum before. This is the Know Your Numbers course. Who is this for? If you've got an existing business, you have a beginner or intermediate bookkeeping knowledge, you want to better understand and manage your small business finances. Maybe you've already got your Xero financial system set up, so you're kind of already on the go. And you're at the stage where accurate reporting is essential for making key decision and forecasting ahead. So going back to that image of the lady on the train tracks, you're kind of at that spot where you've got your past reports going, but maybe you don't have that forecast in place for the future, and maybe you don't have that balance, which is monitoring your KPIs. Maybe you're at that stage. And you also need to be committed to applying what you learn in this right away. So it's an implementation focused program. You work through the modules, but the real benefit is applying them to your business. That's where everybody gets value from this. So if you're interested, you can go into beanninjas.com/KYN or know your numbers, KYN, and you can have a read further about what you get out of it. These are the modules. Module 1, 2, 3. It's 3 modules over 5 weeks, and you also get 5 calls. We adjusted the structure of this, so there's an additional week at the end It's called the GSD week, or Get Shit Done. And this is 1 week where we take the main project your business needs and double down for that week and focus on rolling it out into your business. And then you present at the end of this course what you've done to take steps towards that. So it's really practical, and it's aimed at giving you the accountability and kind of that rocket up the backside to implement these things in your business. So module 1 is understanding your reports. Module 2, making financial decisions. And module 3 is mapping out your business goals. And so we talk through profit first, we talk through cash flow forecasting, we talk through your B&L, your balance sheet, and looking at some metrics as well. But it's all about applying it to your business as well. That's what my passion is getting people just to take the knowledge, because the knowledge is out there everywhere, but it's putting it into your business, which I'm trying to force people to do, or motivate you to do. This is String. He ran through it in the most recent course with us, and he found the accountability factor was the biggest benefit. And being able to ask me live on the call was very worthwhile. Kelly has asked, do you help setting up dashboards? Yes. Yep. I can help you do that if you need. It depends on the source of data and what your key performance indicator is. But Kelly, shoot me an email. Yeah, we can have a chat about that. Definitely. We use a few different options there. This is Justine, who was able to hand over a lot of the data entry and processing to her VA. It saved her 2 to 3 hours a week that she could work on the business. And she can stop worrying about money because she knows exactly how much she's got to spend and where. And she started to put away some profit, which is really good. Again, if you're interested, know your numbers, beninjas.com/KYN. And if you want to use the webinar code webinar25, that's a 25% discount on the price we're offering. If you've lasted for this long, it's fantastic. And we're giving you a bonus here of 25%. So it's kicking off on the 3rd of August. And so enrollments are closing very soon. If you're interested, go to beninjas.com/know